Hello, almost Mongolian here. Um, I write on Substack. I post about investing in Twitter or X, and I have done some interviews on this channel. But now it's time to expand the almost Mongolian multimedia empire to the YouTube videos. So now I'm starting to make YouTube videos, right? And I will start with Ensign Energy Services, which I think is a quite compelling investment idea here. So here we have a disclaimer, nothing said is investment advice, and every single thing could be inaccurate and wrong, and do your own due diligence, etc. So, Ensign. I think I'm a bit too big here. Right, there we go. So, this is Ensign. It's a land drilling company. They own drilling rigs and they drill for oil and gas. You can see the revenue distribution there. They drill mostly on US and Canada, 25% Canada, 68% US. And these two markets are very interconnected. So it's basically 83% North America. That's what we are focusing on this presentation. And they have some international business in various different countries as well. So that's Ensign. Now, why do I like it? Go switch the slide. There we go. All right. So here's the chart. We had a COVID recovery, obviously, with the oil price. Here you can see this is the oil price spike to plus $100. This spike is when oilfield services got like a sector-wide bull market, and here is the last oil price spike to $90 in autumn. So this thing kind of, what it has done recently, it goes up to high threes or fours or even five here, and then it drops back to twos, it drops back to twos, and it dropped back to twos, and now it's one of its drops back to twos. Right, and the valuation metrics there, they're generally quite low. You look at price to book, you look at price to, now the price to cash flow, that's price to operating cash flow, so it's not price to free cash flow. But price to EBITDA under one, and price to earnings is here at much higher, so we will go over that. And EV to EBITDA is also significantly higher than price to EBITDA. So this company has a lot of debt. Now, I made this tweet recently. I think it's pretty good to start. So this company, you can see here the free cash flow last year. And I will go over all of this stuff later, so don't focus on that right now. And so here's the market cap, here's the EV, here's the free cash flow last year. I think it will be higher next year. And it used to trade at a much higher level, despite, like here, it traded at market cap here and EV here. Even though the oil price was lower, they had higher debt and they had worse profitability. So I think this is a sector-wide phenomenon in oil and gas and oil and gas services. Generally the sector is undervalued compared to what it used to trade at in the past. Compared to valuations are low compared to the past. And this market cap, this is this Monday pre-market. So when this video comes out, the stock will be moving around. It won't be exactly this, but I have to obviously pick a point. Right. So I don't think the free cash flow is the best measure for this company, mostly because of the high interest expense, which is not included in the free cash flow, and also because of the working capital movements that can make the free cash flow look better or worse than the company's actual profitability. So I devised this new formula. I think it will be widely adopted by the financial industry in time. It's called Mongolian earnings. So we take operating income and we add depreciation, which is obviously, it's not really an expense. It represents the depreciation of the assets, but it's not a cash expense. And then we take out the capex, which is not in the income statement, and then we might take out the interest expense, which is not in the free cash flow. So we get Mongolian earnings. So here you can see operating income plus depreciation minus capex, and this difference here is what is largely what really kind of pulls back the net income, because I mean depreciation is in many ways supposed to represent capex in the income statement, but with this company the depreciation is much higher than the capex, and obviously this is good for taxation reasons because the net income is lower. And then we have the interest expense, which is quite high, which was quite high. So this is 2023 Mongolian earnings. So it's this much, and this is the price to Mongolian earnings 2.63 for 2023. So that's still a low valuation for price to Mongolian earnings. But when we look forward into this year, their capex budget is lower, and their interest expense is also lower because they had a refinancing and they also paid back a lot of debt in 2023. So we take the debt at Q4. Here they say the blended rate is 8%, and we assume this for 2024. Actually, this will be lower because this company spends its free cash flow to debt pay down. So every quarter the interest cost is going down. But we'll use this for now. So if we use this and this in place of this, and assume this for 2024, then we have Mongolian earnings of this. But now they had a Q4 it was Q4, the last Q4, which is their last reported quarter. It had a highest operating income of the year, but actually lowest revenue of the year. And the rig count was lowest of the year. So the improvement was really driven by internal improvement in Ensign, like cost controls. And here they kind of talk about it. Person asks, was this improvement in margins? Was it like one time? And they say that it comes down to cost controls, and they expect we should see similar margins in the quarters because of the cost control. And here you can see how they had less operating days in Q4, and it was still, I think, the best quarter of the year, and it was the best fourth quarter of since 2022, blah blah blah. Right, so I think it's fair to use the margins achieved in the fourth quarter because that was internally driven. So if we use that, then we get a conservative estimate of 290 million price to Mongolian earnings of 1.6, which is a very low price to Mongolian earnings. So here we went through that. So here's something about the capital allocation. These are excerpts from the Q4 transcript. So at the moment they are laser focused on using all the free cash flow towards debt reduction. And the person asks, what about stock buybacks? They say, well, when we get to sub $1 billion to 800 million, that's when they could start thinking about it. But at the moment, they're spending everything on debt reduction, and I like this because when we think about what would Ensign be worth if it had no debt, I mean, with that kind of profitability, and if the debt was taken out, that would increase the earnings by like 100 million because of the interest cost. Um, the company would probably be worth like 2 billion, obviously. And when there is no debt, then there's also less risk. So the company gets usually a higher valuation. So in a vacuum, it's like if everything stays the same, it should be logical. So their target for debt reduction is 200 million per year on these next few years. They beat it last year. I expect them to beat it significantly this year. But if we are conservative and assume the 200 million of debt reduction, I mean, just in vacuum, logically, that should mean 43% upside from this market cap, because as the debt is paid up, that should get the stock going towards the enterprise value, right? But if we assume this Mongolian earnings, then it's 62.5%. And like I explained there, I think that's a pretty fair estimate. And now I should also tell you why I didn't include taxes on the Mongolian earnings on this one. Well, this company has more tax assets than tax liabilities, and last year they paid no tax. And even if they have to pay tax, and the depreciation pulls down the net income, so and the tax anyway would be pretty low. So it's just you can take something off maybe, but it's not a big thing here. So I just didn't want to complicate things. So I took it out. But it exists, so there could be some taxes. But I think, but even then, it would be in tens of millions. Um, Here's something about their debt refinancing. They did last October. They moved maturity to October 2026, and I assume if they still have a lot of debt there, they're gonna get another refinancing. So I don't think this company is in really the kind of the big debt like 1.2 billion might seem scary, but I don't think they have a problem getting um, credit because of their strong cash flow and because of the people in the company. Like here we have the Sesams, Murray Edward owns 43%, no, 43 million shares. So that's a big chunk of the company. And this guy is the chairman, and he started uh, Canadian Natural Resources, one of the biggest companies in Canada. He's also chairman of that company. Magellan Aerospace, 100 million company, Ensign Energy Services, obviously. So this is having this guy own such a big portion of the company and be the chairman. I mean, he obviously knows all the banks, and that's obviously a very good for the company. Now the insider purchases here, not much in the last 20 months, but the like just two insiders buying. But the CEO, he is bought like over 700,000 last autumn at like $3, so higher than the stock is now. So he made a big, showed a lot of confidence last autumn when the stock was higher than it is now. Now, okay, so yes, this they have kind of reduced the net debt, increased the EBITDA, but you can see the market cap hasn't really been rewarded. Here you can see it. 2019 market cap and the enterprise value is so much higher than now, even though the company has higher EBITDA and lower debt. So what can you say? That's just how it is sometimes. At the end of the day, stocks move based on the supply and demand of shares, and supply and demand of shares is a lot of the times it's based on sentiment and things like this, but we can't control them. We just have to make a good risk reward based bet based on fundamentals and wait. And try to be right, and in time that tends to work much better than any other strategy. Right. So now we go to the sector fundamentals part of the video, which is quite important because that's really what drives Ensign's earnings. It's a business that is in the mercy of its sector. It's just the supply and demand of their product, which is the rigs. Now, the rig count has been dropping during 2023, and I mean, despite that, Ensign had strong year, and here we have then the U.S. oil production still went up despite the rigs dropping, and now the question is why. This comes down to these DUCs, right? So these DUCs are drilled but uncompleted wells. So here you can see the amount of these DUCs. And so drilled but uncompleted wells. So what US producers did is they completed these DUCs. So they have been drilled, and now you just complete the DUC and the oil comes out. So this is how they increase the oil production, but we can see how low the inventories of the DUCs is getting. And a lot of these DUCs left over, they're not even economic. They're called dead DUCs, dead DUCs. Here we have a live DUC, but a lot of these are dead. These are not like this DUC here. So this kind of makes sense, right? They dropped rigs, but they compensate with these. But there's not much left of these anymore. So at the end of the day, if the oil production, if the producers want to keep their oil production up, growing or stable, they're gonna have to drill more. And as we know, that Ensign is 83% North America. The two markets are interconnected. This is a very important point because this is important because this is the base. This is the base we are leaving off. So this company still has strong results with rigs being here, but when they're gonna have to start drilling more, that's gonna push the rates up, and the rates, that's it, gonna increase the profits. All right. So here we have US rig fleet. So these are basically land rigs. At least I think these are basically just land rigs. So you can see what has been happening here. Removed out of service. A lot of rigs removed out of service. Not much newly manufactured. Look at how much destroyed. Last year more destroyed than newly manufactured. Now, and removed out of service. Look at the net change here. Additions and reductions to the fleet, net change of this. So total available rigs is going down. So these companies are not really building new rigs, and a lot of rigs are getting scrapped for steel and stuff like this. So, and they're getting old. They're not even economic to use anymore. They're not for the modern times. So this, I think, is really the ignored part with these companies, with the onshore drillers especially. Like offshore drillers, everybody kind of is aware of this, but onshore drillers, people don't really seem to be aware of this. So this is probably the biggest part of the thesis, honestly. Now, well, this is just some quick stuff. I looked at the biggest drillers in US. So neighbors. So I just looked at the transcripts. So I don't know if this is completely accurate, but what I found, Neighbors was doing some new builds in Saudi Arabia, and Ensign and Precision, they are not doing any new builds. And Helmerich and Patterson, at least by the quick look, I couldn't see them doing new builds. So companies generally aren't really building rigs. You can see the net change in US fleet. You can see the rigs available and the utilization rate. And I think this is the situation. I think we are going into a market of rising demand for rigs, which we are getting into later. Why? Here's the Canadian fleet available rigs going down, like been going down for a long year. One of this is also one driver is also the improvement in efficiency of rigs. So more is done with one rig, right? But this is still quite a decrease in the rigs. But it can be hard to say how much is efficiency, like how much can be attributed to efficiency. But when the base is so low and the earnings are already good, let's say, what if they can run with this? What if it doesn't become really a problem and efficiency deals with it? Well, Ensign is still going to have strong earnings. They're still going to have the debt pay down and they still should increase in value. Now, this is from Precision Drilling presentation. Here you can see the margins they got. Now Precision has some super rigs, I guess. So I don't know if that's completely comparable to other companies, but this is what I found. Ensign didn't have this kind of nice pictures. And here we have another the Canadian drilling rig going down. This is also from Precision that recently released Q1. The rates in the US are down a bit from last year. Like this is a very small decrease in rates when you consider the drop in rigs, So and Canada, it's going up, and well, international it's up a bit, and this is basically the same as Precision is the most comparable company to Ensign. It has basically the same revenue, almost the same revenue distribution than Ensign, and it does the same thing, etc., etc. It also has a higher valuation than Ensign. So I think Ensign is also cheap compared to its peers. Now we go over why some of the reasons, some of the things that I think will be driving, well, I mean, a lot of other people think will be driving the rig demand up in US and Canada. So we have the Trans-Mountain pipeline, and this is expected that they're going to have 8% more wells in 2024 in Canada. Now that might not seem like much, but you have to consider the pricing of this. I mean, rigs, they're basically a commodity, so it's done at the margin, and that also, like, you might look at this and say, well, Ensign only has 25% of their revenue in Canada and 8% more. It might not seem like a big deal, but US and Canada are very interconnected. So if Canada has more demand for rigs, and that raises the rates in Canada. Companies are gonna move rigs from US to Canada. That's gonna reduce the supply in US, and that's gonna increase the rates in US. So it's all. So they both. This also helps the US business. I mean, Ensign was already did this in this autumn. They moved few rigs from Canada because there's going to be demand in Canada, because Canadian production, it has been, as you can see here, it has been restricted by the pipeline capacity, and here we have the increasing pipeline capacity, so they can produce more oil. Right, so LNG is also will be a big driver of increasing demand for drilling rigs in North America. US is the biggest LNG producer, and Canada is not even on the list, but it should be on the list in the coming years. The LNG export capacity expected to double by 2027 in North America, mostly US Canada driven. There is LNG Canada happening, and that's gonna start. It's gonna be starting at 2025, which is not a long way away. People usually have a too short time frame. But 2024, 2025. That's just right around the corner. That's just 1 year. So that's also gonna boost. That's gonna boost. There's gonna be a new pipeline. So the Canadian producers um, can produce more natural gas, and that should also help the Canadian natural gas prices because of more demand, and increase the drilling for natural gas, which should help Ensign and other companies like it. And there's also projects in US increasing their LNG export capacity, and same thing in US that should increase drilling for natural gas. Net export expected to grow by 6% in 2024 and 20% by 2025. Right. So there's that. Okay, that was it. So maybe at the end there's still, like, I am bullish oil in general. So I think there will be more drilling just based on higher oil price in the coming years. But I kind of wanted to focus in this presentation on things that are happening despite the oil price rise. LNG Canada is happening, LNG US is happening, like LNG production export capacity increase in US is happening. The ducks are low. The rig fleet is shrinking. The demand should be rising. The earnings are already strong. Ensign has a solid capital allocation plan that might not, but should increase the stock price in the coming years. And I think it's quite a good, solid people in the company. So I think it's quite a good risk reward here. Yeah. So, sub to my Substack, follow me on Twitter, and sub to this YouTube channel. I will be putting out more content like this in the future.